Happy Thursday. This is Pedro De Leon.
Hey, what's happening? And this is Chihiro, and we are Beyond Stocks. We're bringing a great show to you today. Thanks for joining us. We got Dan Olsen with us. He is a CFO. Welcome to the show, Dan.
Yeah,
Hey.
so let me give you a quick introduction here, Dan. I know you have an extensive background as a CFO. So Dan has 25 years of experience in finance, accounting, and mergers and acquisitions. He's a multinational. He advises multinational corporations and private equity firms, such as industries as oil and gas, manufacturing, healthcare, and there's a long list. But right now, he is currently director of NOW CFO, and he brings expertise in strategic growth, financial modeling, and deal execution. Dan, I'm glad to have you here, man. Finally, man, got you on the podcast.
The stars aligned and we're all on here together. That's great.
Yeah, absolutely.
Happy to be here. I watch your show. It's fantastic. Like you said, 25 years of experience, CPA. Started out as a little auditor, a little company called Ernst Young, and then kind of graduated out of that and went into mergers and acquisitions and financial diligence and a couple of stints in corporate development. And I pretty much have looked at about 5,000 different companies and helped execute about maybe 300 deals over my years. Wow. And as you kind of alluded to, in multiple different industry groups. But very happy to be here today to talk to you guys about M&A diligence.
Yeah, absolutely, man. I'm excited to have you on the show. These are some of the important things that when looking to invest, or any LPs looking to invest in an operator, right? What is some of the things that we need to be aware of? So I'm glad to have you on the show for sure. And let's get the show started. So for me, what are some of the industries that you can say what not to work with, or you say, hey, this is not a good industry, versus the ones you work with, right? Because I know you worked in oil and gas.
Yep. I'd say I focus more on the traditional industries. I'm not necessarily I'm not saying you don't go into real estate, but I don't really focus on real estate, so to speak. Mm-hmm. But or crypto, I don't really touch that. Okay. It's something that there are other people that are very much into it. I just haven't really got into it yet. It's just a different beast, different animal, so to speak.
Yeah, I don't think none of us actually got into crypto, but yeah, it's something that we can definitely explore in the future. I don't know what you think, Chihiro.
I've got a little bit of play money in a Robinhood account in crypto, but nothing serious.
About 10 coins sitting around, right?
That'd be great. Yeah, not so much though.
Yeah, definitely. But so with that, here, what are some of the things that people should be aware of when looking to invest, or looking to acquire a company, or looking to invest, like I said, into an operator when it comes to M&A?
So one thing I will say this is never be shy about asking questions, and then really listen to the questions and how they're answered. If they're defensive, that's a definite red flag. If somebody should know, if they're trying to sell their business, should be very open and very thoughtful and to entertain you in what you want to know. I mean, yes, there is a case where if you're in a process with somebody and, you've gone through a huge, a bunch of long-term diligence process where everybody's getting deal weary, I could see that there could be a little bit of, ruffled feathers between the two groups, but yeah, watch what they say, and you can see how their body language is. I know it's difficult now. I used to love it when we used to go on site, and now we're doing more remote diligence, but just to watch the body language of people and how they're squirming around a little bit or something, or what they're doing underneath the table with their hands or their legs. That's key. Those are just like big triggers.
You bring up a good point there, because that's something that I've learned and took a program in the past, body language, especially when you're negotiating or just trying to sell someone, so it's important to keep that in mind. Yeah, absolutely.
It's a big keys there. I mean, the FBI knows when they can tell who's lying and who's not, and how they're looking away when they're answering questions. I mean, diligence should not be taken lightly, just because make sure people represent what they're saying in their financials. And Ask the hard questions. Like I said, make sure that there's support and there's data backed up and what they're doing and what they're saying historically. Do you have good data? Is this really a representation of the performance of the company? And then two, where is it going? Do they have a model set up? Mm-hmm. Can they prove it out? Can they explain it? Do they have good assumptions? You need to know that. I mean, this is your money.
Dan, without going into specifics or naming names, can you talk about a situation in which you had a deal where the diligence did not yield, things weren't as they should have been, basically?
Yes. One comes to mind. I went out on I was corporate development at a company, publicly traded company. And we went out into the field. We didn't know much about the company. We know about what they did. And almost within the first day, I looked at their financials and it was very splotty with regard to revenue. I'm saying this very choppy. Mm-hmm. And we were told that it was a subscription model. And I found out it wasn't. It was project-based. And pretty much wasted our time out in the field, only like 2 days. However, did get to go to a really great baseball game that night. But it definitely wasn't representative. It just wasn't a representation of what we wanted.
Got it.
Well, to talk about that, what are some of the common denominators that you've seen with companies having challenges, issues with their financials?
What I would say more common is when they say that they have like a bookkeeper. And I can understand that there's a certain level of sophistication of these companies. I mean, look, if you're a $10 to $20 million company, you're not going to have a full accounting team with a CFO, controller. There's going to be some blending of roles. But when they start talking about like, oh, we get a review done on our financials. Reviews are just really just doing a quick flux of the financials and really not really digging too deep in the numbers.
Oh, wow. So if the company, let's say, if they're making over $1 million, what's some of the best advice you can give them?
I would say first and foremost, make sure what I call is a cash proof. Prove out, reconcile the cash coming into revenue. So there is cash coming in. We know it's a legitimizes revenue, and then do the same thing for expenses and COGS. That's baseline. So now okay, I know what the cash flow is. Now, that's the first and foremost part of it. And then you start extrapolating it and getting into more of the details of how things are going and talking about concentration risk on the customers and whatnot. But that's what I would do. That would create like a box and you're like, okay, now I know I'm in the right field or stadium, so to speak, for the game. Mm-hmm. And now let's start digging into this.
Yeah, absolutely. And so with that, let's kind of switch it to M&A, because I know we talked about this yesterday too. When it comes to post, because let's talk about post. What are some of the things that people should be aware of when taking over a company? I know there's a lot of categories you got to check marked.
Right. Well, there's still after you close a deal, the deal's not it's over. From the standpoint of negotiations, but you do have to do a working capital true up, most likely 30 to 60 days after close. And sometimes people forget about those. And then you're pretty much held accountable to the seller. The seller's on top of it, and they've kind of calculated things. You're going to be behind the 8 ball, and you got to make sure that that's correct. And if there's an adjustment, and there's a disagreement on that, then it's got to go to a mediator or a third-party CPA firm, which it's normally named in the purchase agreement. But other things to do is the integration part of it. I mean, maybe this is a standalone, this is a platform, but there's also things that you've learned during diligence that could be improved, like the financial statements. Let's get the close completed faster. They're closing 30 days after your month end. Well, let's try to get to 15. Let's have a month end checklist to get things closed faster and get attention to it and make it a priority, because you can't make business decisions on like old data. Right. That's one. Make sure that there's a budget and financial model set up so that everybody knows what the goals are for the next coming year. I think those are the key things. Now, if you're adding on to a platform integration, make sure the systems are integrating correctly. The two ERPs, it's a pain in the neck to consolidate at the end of the month, try to get a good system in place so you guys can actually do this and flip the switch and get good consolidated financials.
Yeah, go ahead, Shiro.
Oh, how often during an M&A active action do you find the buyer like retrading the deal based on something they found during diligence?
I would say it probably happens 30 to 40% of the time.
Got it.
And it's after when we're doing diligence, we're really held accountable to get it to the biggest red flags as fast as possible. And so we're out there, we are beating the bushes for 2 days in the field. That's the way it used to be. And we have a laundry list of things. And then we try to quantify like, hey, there's issues here. This is not accrued. We're seeing a huge drop off in sales. The pipeline's not right. The backlog is not right. And then we communicate that up to our particular client. And then they negotiate it and talk. And then we probably will have like a little layover where we'll stop for a little bit, pencils down, and then we'll pick them back up.
Got it.
For transitions, how long does it typically, in your experience, have taken from a company making an exit or transfer or making a merger?
We mean like from when they started up?
Yeah, when it started up too.
I would say it just depends. I'd say 5 to 10 years. To actually go from startup, and then you start up, and then it takes a couple of years, right, to get positive cash flow, and then maybe a couple more years to actually build this thing out to where you can actually sell it into the market.
Oh, what I meant to say was, let's say if a company is thinking about making a merger.
Oh,
or you're looking to make an exit, like typically how long is that time frame?
Oh, okay. So normally what happens if they involve an investment banker, that will take a couple of months for them to pull together a good bunch of marketing materials and then to prospect it out to the particular buyers. I would say that takes about 3 months to find a buyer. And then it takes, I would say, 3 to 6 months to actually go from LOI to actually completion of a sale.
Well, and I've heard stories too, like, it's taken 2-3 years for companies. And I'm thinking, it's because a lot of their financials or their their SOPs are not set up properly to make that exit. So
there's always like one little thing that would potentially cause people to get a headache. It could be anything. Like there's a concentration risk in their customers, but look, they're going to take a little bit of a hit on the valuation on that, and they talk about how they're going to mediate that into the market post close. It just depends. It really could take a long time.
Yeah, definitely. So what some of the industries are you seeing right now that there's been a lot of activity as far as mergers or some exits?
I think your blue blood industries. I see a lot of manufacturing distribution right now. Healthcare is still really hot. Actually, engineering construction in the Southwest area is really good right now.
That's interesting. Yeah.
Engaged on a lot of different things with regard to M&A.
I know manufacturing. I've been seeing this lately, especially we have a mutual friend that is actually having an event this month in manufacturing. So, and those are difficult to pull out, right? It's difficult to kind of find company, the owners, but definitely there's a need because there's always a transition going on with them, but they don't know how to go about, making that exit. So, yeah.
Right. It's a big deal. I would advise people to to not do this on your own.
Yeah.
And to get people, the professionals that have experience to help you negotiate these because if you don't have somebody help you with the negotiations, the other side definitely does. And these are people that know the ins and outs, done this for 20 years. They know how to set traps. I'm not saying they're going to be unethical, but hey, look, they're all trying to get the highest valuation for themselves or the lowest one if you're buying, right?
Right. Yeah.
Yeah. And on the sales side, when I've talked to people who broker deals, a lot of it is consultative, like getting the books in order so that it's ready for sale. And so it's not just a matter of, oh, I have a business, I'm going to sell it, and then it's listed tomorrow. Like there's a lot of work that goes into it on both sides. Or to your point, Dan, a lot of work that needs to go into it for you to maximize your proceeds.
No, the key here is once you get an LOI, you think of everybody's got a decent level of skepticism, right? You're going to be skeptical, but what you want to do is you want to prevent the other side from the skepticism to go way up. If it goes way up, the first thing they do, they try tying out numbers and they're not tying out. Skepticism goes way up, and then the valuations start dropping from there, or they just walk away because they don't want to deal with this. They don't want to deal with like bad data. They need to know what the numbers are. A lot of people are risk averse on that.
Here is some of the things that I've heard in the past. Sometimes founders or owners, right? They have a number in their mind that say this is how much I can sell it for, but yet they don't have the data backing up. Like, it's one of those, like, you gotta be upfront with them and say, look, let's have a hard conversation.
Mm-hmm.
I know you have a number in your head, but based on what you've given me, your valuation is a lot lower than you think. And so,
Right.
And it's like, it's interesting to kind of, and I understand these owners, right? They've been putting sweat and tears into the business, but capturing data is really important and keeping it organized, so
It is. And then, have good data, but then be able to explain that you understand your business. That's another part of it. I believe I go in there and I'll kick the tires, and it's amazing to see, like, they have to go back and research certain things. Like, wow, you don't even know why these numbers are going up or why there's a change here and what that large balance outside of 90 days on your AR aging is, and why, you could tell right away within the first day. You could tell if somebody really knows and it's very intimate with the numbers.
Dan, looking back on your career, can you give us like an example or two of an operator where you thought they really had their ducks in a row? It was really well prepared and made for a good transaction.
Yeah. No, it was a couple of years ago. It was a company that, believe it or not, was doing, they were still doing it back then, videotapes into the discs, the CDs.
Uh-huh.
People were still doing it. He had monopoly over the business. And I was so impressed by the fact that how they had procedures set up, and there was a standard in place in almost everything they did. And everybody on the team knew what their responsibility was, and it made it just very fluid. And the processes set up were amazing. So in other words, this person had good organization, but delegated very well and had a good team around him. It was very impressive. And there was really very little adjustments to EBITDA on the QV.
Got it. How about the flip side of that? Like, what's an operator where you were like, wow, this is bad, and then can you explain to our listeners why it was so bad, so that they know what to avoid when they're looking at a business deal?
I've alluded to it before, the defensiveness. I'm not going to tell the location, but we went to a particular deal, is oil and gas, and the first day, look. A lot of this has to do with inventory at the time, this particular company, and we were starting to beat it up. We knew that was a big risk area. And the owner said, I don't want to hear any more questions about inventory anymore. And I'm like,
wow.
There was, it was pretty intense. We kept talking about it. didn't want to go there. The investment banker was in the room. It was really uncomfortable, but we didn't do the deal, by the way. And he should have done the deal because, well, this is back in 08 or something, or 07, before oil really tanked. But should have sold, should have played nice, because then he had to hold the business. I forgot how many, he was going to get 60 million in enterprise value, but within 2 months later, I think the thing was probably worth 10.
Yeah.
Wow. Yeah.
And from the sound of it, he had way too much money tied up in inventory.
Yes.
Which didn't help, right?
Right. That's why we don't keep track of inventory. Why do we need to keep track of inventory?
Because it matters.
Yeah, definitely. Well, so definitely some cues there, right there. If you're looking to invest with an operator, right? So keep that in mind. How some of the red flags there. What are some of the interesting, deals that you went through in the past? Something that you'd be like, wow, this was like one of a kind or something like that.
Okay, that's easy. Right off the top of my head, I was hoping you guys were going to ask that question. My favorite one I ever did, it was in Reno, Nevada, and it was a big public company that was selling off one of its big assets, and it was in mining, and it was a gold mine. Mm-hmm. So I did diligence on a gold mine, and we had to do a site visit. So we were in the offices in Reno, but the gold mine was way out east. And I asked them for the address, and they said there wasn't an address. You just had to drive on this highway until about 45 minutes until you got to the location. But the mine itself was already pre-blasted. Not to go into the specifics of this too much, but they were spraying with a sprinkler system cyanide all over the rock and the ore. And when it combines with gold, it loosens the gold from the other minerals. And then it goes down to this big filter. So that was a lot of fun.
That kind of reminds me of Jesus, what was that when they were spraying was it Mountain Dew or something like that? One of the movies, Jesus, I don't remember the movie. They were spraying Mountain Dew.
Wait, you're talking about the one where it takes place in the future.
Yeah, it takes place. But anyways, it just kind of reminds me of that. But that's interesting to know. Definitely. And what are some of the ones that you say, hey, you know what, I can't believe this went through, but it went through, but it shouldn't went through.
Okay. This is another good one. Another business in which, just really quickly, the balance sheet looked at the fixed asset register, and I saw Ferrari, Lamborghini, Porsche. That was a red flag. And then the other one was there was an account, and this is what us accountants just love. There's a big credit balance and is an expense in admin. I'm like, what is this thing? It's so big. I don't understand what this thing is. Mm-hmm. And I kept pestering this controller until he pulls me in his office. He opens up his computer. It literally was it was the net number of another QuickBooks account. Mm. And I said, wait a minute, we're still like cooking some books here or something here. And then what's this extra set of books? And we went into details on this. I talked to the PE firm about it. They took it. I think they kind of maybe had that already in their minds. We were able to get to the right number, but I've been telling you that it's just so many red flags, and there was a little bit of excitement there.
So what are the consequences, like if a business owner were to put personal assets onto the balance sheet of the company, what are the ramifications of that? Can you kind of explain to me, like I'm a third grader, like why is that bad?
Well, it's just the commingling, and then you got to figure out whether or not these assets, I mean, the Lamborghini is probably pretty obvious. You don't need that for the business, the one that we're doing.
Oh, damn. Okay. Now I know. Thanks.
You might need that. There's a good way you can get that deducted, I think, Pedro. I have some good tax accountants you can talk to. But it's the commingling part of it. Like, why is this in here? And then it's just like the expenses. So you see the expenses that are commingled into the business, the personal expenses with business. Then there's this big thing, like some of them are obvious that, okay, you get some dry cleaning or a doctor's bill, but some of them are not. Like, wait, you took this person out to lunch. Isn't that what you guys do for business? You're doing business development. So why are we adding this back?
Mm-hmm.
But 9 times out of 10, there's personal expenses going through.
And why, what's the incentive for the business operator to put his or her, personal vehicle onto the books of the company, just so the company will bear the tax implications of it as opposed to them personally?
That's it. It's deductibility, right?
Got it.
So I have one more question, and this is when a seller sells his business, and one of the biggest things that are omitted, I noticed this in the past, especially when I used to work in the financial services, is that there is tax, what's it called, capital gains. What are some of the things or any strategies that you can probably share or of that say, hey, this might be something, but obviously, talk to a CPA for this, that can definitely help them with post.
Right.
Yeah.
One of the biggest, so initially when you start doing deals, I would have a great lawyer or tax accountant that has a lot of experience in this, because that right there is minimizing your tax liability is like, I would say 50% of all this, outside of having a really good company to sell, but you don't want that all to go away and get hit with a big capital gains tax. You just don't. And there's ways of doing it and ways to get around it if you're smart. But you have to be organized, and you have to get out there and plan this.
Right. Yeah, this is one of the biggest things that I've heard in the past. I was like, hey, I just sold my company. How can I, mitigate this? I'm like,
It's too late.
Yeah. So you definitely want to speak to a professional, to have a professional team,
right,
backing you up. So for sure.
This all goes back to asset deal, stock deal.
Mm-hmm.
I mean, there's a lot of different things. If you're just brand new going into buying businesses, you need to know these things. You need, you do need to get a trusted advisor. Keywords trusted.
Right. Absolutely. And talk about trusted advisor. How can, people can get in touch with you? What is the best way?
By LinkedIn or email, Dan.Olsen, Olsen at NOWCFO.com. We don't do QV work, but we do everything outside of diligence, assisting with the process, helping with the data rooms, post-merger integration, the first 100 days, setting things up, helping with ERP systems and whatnot.
Definitely. Dan, thank you so much for sharing your insights. Chihiro, do you have anything else?
No, really appreciate you spending time with us here today, Dan.
Hey, glad to be on here. I finally made it.
I appreciate it.
Thanks, guys.
Yeah, definitely. Thank you. And for those that have been watching, thank you so much. Any questions you have, send it over. We'll send it over to Dan. We'll get you guys connected over LinkedIn. All right.
Thanks, guys.
Next time. Take
Appreciate
care.
you. Thank you.